Thanks, Joel. It's a pleasure to be with you today and speak about climate finance. The year 2020 marked a turning point in planetary systems. It was the warmest year on record. Hurricanes, wildfires, and floods, exacerbated by climate change, totaled $210 billion in damages. If climate change continues unabated, global economic losses could reach $23 trillion each year. That's 3 to 4 times the scale of the 2008 financial crisis, and more than 3 times the predicted contraction of global GDP due to COVID-19. Yet, if we invest in climate solutions, not only can we avoid those losses, but we stand to gain between 1 and 7 trillion each year in net economic benefits. In order to reach net zero, we have to at least triple our current annual investments. The good news is that we have more than enough capital in the financial system to meet this need and bring risk-adjusted returns to investors. To be more precise, we have close to $250 trillion in the global financial system, with over 100 trillion in the form of bank deposits alone. Now, we all know about the barriers. Some call them excuses. For the lack of climate-friendly investments, these barriers can best be summarized by inertia. We are so stuck in old models, outdated data, and archaic due diligence processes that we miss the best ESG climate-forward opportunities. In the audience today, I know we have lenders, investors, and financial advisors who are driving capital for a greener economy. Here are 2 things you can do. Number 1, embrace innovation. And number 2, systemically decarbonize capital. First, innovation. For the incumbents, not only will trying new approaches to investing support returns, but this will also ensure survival. Over 35% of all banking revenues could be at risk if incumbents fail to innovate and adjust. By mobilizing less than 2% of the capital in demand deposits, the US would surpass the amount of additional investment needed to reach net zero by 2050. So help consumers align their deposits with a just climate future. If you are in the banking business, join the Bank for Good campaign by going to bankforgood.org. For the disruptors, the terrain is ripe. Customers are unhappy with their insurance providers, banks, and asset managers. Step in and lead with a climate-forward approach to investments. I'll provide 2 examples of innovative finance within our work. The first is Prime Coalition's Impact Fund. Prime is a climate impact first fund that invests in startups whose solutions mitigate greenhouse gas emissions at the gigaton scale. While traditional venture capital is great for capital-light innovation, VC is not structured to support transformative hardware-based innovation in power generation, transportation, manufacturing, and agriculture. Prime innovates in a number of ways, from the duration of the fund, 15 years instead of 10, to a sector-agnostic approach that focuses on the carbon wins wherever they occur in the real economy. Prime's portfolio companies are philanthropically de-risked, which means they are literally primed for follow-on investment from asset owners seeking alpha. Another example from our work comes from the New Energy Nexus, which just released their first-of-a-kind report on climate fintech. 75% of climate fintech companies are early stage and have received under $10 million in investment. This means the ecosystem is ready for capital that enables customer acquisition, growth, and exit. The most activity in climate fintech can be found in asset management, open banking, payments, trading, and risk analysis. New Energy Nexus is launching a global climate fintech accelerator to support its trillion-dollar opportunity. The second thing you can do is to embrace systemic change. If you are a sustainability banker or an ESG researcher, walk across the virtual hall and speak to your colleagues in public affairs. Did your CEO really just commit to net zero investments while your lobbying team is funding climate inaction policymakers or urging financial trade associations to speak out against climate finance regulation? There's only so much that any one firm can do. We need the entire financial system to support the real green economy. Clear market rules make it easier to default to the climate-friendly, environmentally and socially just bond, ETF, project finance fund, VC fund. Here are two examples of how we support systemic financial change. One is supporting the global adoption of the Partnership for Carbon Accounting Financials, also known as PCAF. PCAF has developed a universal, harmonized, and transparent standard for measuring and disclosing the carbon emissions of loans and investments, known as financed emissions. There are now over 100 banks and asset managers from South Africa to Ecuador, with over $27 trillion of assets under management, who have taken on PCAF. The second example is supporting financial regulatory change for a carbon-constrained world. In the last 10 years, the S&P energy, aka fossil fuel sector, gained only 1%, while in the same time period, the broader market gained 212%. $1 in $3 of US assets under professional management are sustainably invested. The market has spoken. But let's not kid ourselves. We know that ESG labeled funds are more often than not very weak on climate impact. We need lenders and investors to use their voices for regulatory action. This includes policies that mandate the disclosure of financed emissions and protect workers' savings with clear mandates to incorporate climate risks and opportunities into fiduciary duty. The climate science has spoken. We are living in the decisive decade, and financial capital is the engine of our reality. Now is our turn as industry changemakers to decide on a planet that works for people and act as people who work for the planet. Enjoy Greenfin 21.